Contrary to popular belief, no, the stock market does not work off of the economy. Not fully, at least. It's very important to understand that they are disconnected. This is not them. They are nothing like Matt Damon's incredible work called Stuck on You. And if you don't know what I'm talking about, then I'm actually happy for you that you did not witness whatever this was. You should really just count your blessings. But in this video, I'm going to explain why the stock market doesn't seem to mirror what's going on in the economy. And first, we're going to go over the explanation that most people give, but then I'm going to give you the actual explanation, the real reason that they're disconnected, because the first answer that most people give, it doesn't cover the full picture. It's kind of right, but not really. And obviously this is very important to understand because life is already so confusing. Like, why did Matt Damon think that doing this movie was a good idea? Very confusing. And on a more serious note, when you're looking around and you're seeing businesses shutting down, your local pizza shop not operating anymore, your friends, your family losing jobs, but at the same time the stock market just keeps going higher, of course you're going to be wondering what the heck is going on. And the same thing happens in the reverse. When everyone is doing really well and the stock market starts falling, you're thinking, what is happening? And most likely, if you're watching this video and you have a job, you likely have a 401k and you have some investments for retirement, right? And where are all those investments? Most likely in the stock market. So it's important to understand how the stock market functions, especially in relation to the economy, so that you don't end up doing something stupid because you didn't know. Don't be this guy. You want to know your stuff so you can avoid whatever this is. Now, like I said before, most people will give you one answer on why the stock market is disconnected from the economy, but I don't fully agree with it. But we'll go over it regardless so you could understand what I'm talking about when I give you the real reason they're disconnected. So when you see the stock market flying higher with the economy collapsing and you ask an expert, why is this happening? Well, they're going to tell you that it's happening because the stock market is forward looking, meaning that the present scenario, what we're dealing with in the economy, doesn't matter. Now, what's that mean? What does it mean that the stock market is forward looking? It means that the prices in the stock market, how high the S&P 500 is, or the Dow, the NASDAQ, all of that, it's going to reflect what investors think is going to happen in the future, not what's happening right now. So if in our example, the economy is collapsing and prices are high in the stock market and keep going up, then the way to read that is that investors think the economy is going to recover and things are going to be a-okay. So for the market to be forward looking, it means that the market is always ahead of the game. It's playing the future, not the present, which is why this could be the economy, everything on fire, but here are investors right here, everything's fine. And you might be thinking, well, how can the stock market predict the future? How do investors know? Well, they don't actually know. Individually, none of us know anything. Individually, we're all very stupid. You, me, Matt Damon, all of us. But when you put us all together in a system like the stock market, then there's something called a collective wisdom that develops. So through that collective wisdom, which is portrayed through the prices in the stock market, because it's where everyone is putting their money, right? Well, you could read that as a signal of what will happen in the future. Now, of course, that only works somewhat, and that's kind of the problem with this explanation, because none of us can predict what's going to happen in 5 years. Even the stock market can't. Could anybody have predicted that a reality TV star would be our president before he did it, let alone 5 years before? No, of course not. Another great example is Tesla. If you look at Tesla right here in this chart, it went straight up this year. It's like 7 times bigger than what it started at in the beginning of the year. Up over 600%. And what does that mean? Because the market is supposed to look at the future, right? Tesla, is it a good company? Sure. Is the company good enough to see the stock price shoot up by 7 times or 600% or however you want to look at it? What is the market actually saying about the future of Tesla at this price and the fact that it keeps growing? Are we going to see Elon fly in a Tesla straight to Mars with his 4 celebrity wives and become the king of that planet? That's basically what the stock price is pricing in right now. It's that ridiculous. And that's when you kind of start to think, okay, maybe something is a little off with this idea that the market just predicts things in the future. It's forward looking. Because even when the economy is really bad, a lot of businesses closed down, people lost their jobs. How exactly is everything going to recover so fast? Does that really make, logical sense that the stock market should be at all-time highs and continue to climb? And that's why I said this explanation about the stock market being forward looking, which is why it's disconnected from the economy. Kind of true, but not the full picture. The real reason the stock market can shoot up like this with businesses all shut down, well, that's a little more complicated and more advanced, which is why most people don't understand it. The only reason I understand it is because we run a global macro research firm, which means we're doing economics all day, every day, and applying it to the stock market. That's literally our job, measuring that disconnect between the economy and the stock market. So let me explain what's going on to you. And the big reason why the stock market is so disconnected from the economy is because of a concept called liquidity. So what is liquidity and why does it do this? Well, liquidity is how much money is sloshing around in the economy. And the idea is that the more money there is in the economy, the higher stock prices will be. Now I'm going to explain more, but I want you to remember something. It's a great way to think about liquidity, so you never forget. So here's how I think about it. Liquidity, what is it made up of? Liquid. What is liquid? Well, liquid is wet. And what do we all know? We all know that wetter is better. So more liquidity is very good for stock prices. Wetter is better. That's what I always want you to remember. It's what you need to take away from this video. Wetter is better. But okay, let me explain a little more about what all this means. First thing I want you to think about is interest rates for your mortgage or anything else. Interest rates are what we look at when we need to borrow money, right? And how are interest rates right now? Well, they're extremely low, which means you could pay very little money to borrow a bunch of money. And this goes back into everything you hear about the Federal Reserve lowering interest rates, stimulating the economy. This is how they do it. They make it cheap to borrow money. So if money is cheap, people are going to keep borrowing and they'll have more money, which means more liquidity, more wetness. Think about all the stimulus we've seen from the government, the checks they're giving out, the bailouts they give to companies, the loans that they've given to companies, the PPP loans and all of those. All this money printing that's constantly going on, all more liquidity. And this is when you could bring it back to basics, because what happens when you have a bunch of money? You're going to spend it. And that's exactly what happens in this scenario, which is why it's so important to see. So if we say there's a lot of liquidity in the economy, there's money everywhere, people are going to spend that money. Businesses are going to spend that money. And in this case, they spend it on stocks, on assets. And that's why the prices go up. Because if you have all this money that keeps growing, right? More and more money is being pumped in. It's still chasing after the same amount of assets or stocks. So this goes back to economics 101, right? Supply and demand. The supply of stocks is the same, but the demand is increasing because all this money is coming in. It's burning a hole in people's pockets. They got to spend it, and they spend it on stocks. So way more demand, same amount of supply. What happens to the price? It goes up. And you might be thinking, well, companies don't buy stock, but yes, they actually do. One of the biggest drivers of this stock market since 2009, after the whole great financial collapse, has been corporate buybacks. And corporate buybacks are basically when a company has a bunch of cash left over, they look at actually buying their own stock. Why would they do that? Well, that's because the executives at the company, the boss, the CEO, their compensation is tied to the stock price. Their stock options, right? So of course they want to buy their own stock, because when they do that, the price continues to go up. So they get paid more. So when money is cheap, everybody borrows it and everybody piles it into the stock market. And this is where you could see that the stock market might actually connect to the economy more than we thought, because when the economy is really bad, what happens? The government tries to stimulate it, right? That's when they drop the interest rates. Federal Reserve does. That's when they start giving out more money. When that happens, stock prices shoot up. So it's almost inverse. Bad economy is actually great for the stock market, which is why a lot of times over the last 10 years, you would see bad news come out, something terrible happen in the economy, and then the stock market would shoot up. Why? Because they knew the government would step in and stimulate. And by this point, you might have noticed a big flaw here, because why was the government sending out all this money in the first place? It wasn't to inflate the stock market. It was to help all these businesses and all these people that got into trouble, right? So you help companies out, that way they could keep hiring, not fire their people, and the economy recovers, right? Well, no. Not so much. Unfortunately, like I said, what these businesses do is they hoard that money and then they are going to put it into the stock market. And you've probably seen something that's just so frustrating to me, is that all these big businesses have been getting a lot of help when they don't actually need it. These big corporations that have a bunch of money already. But it's your small local stores, like the pizza place that I was talking about before, they're shutting down. They're not getting the help that they need. They don't have the big balance sheets. So it's those big companies taking the money, putting it into the stock market, inflating the whole thing. And I'm sure you've seen the stories of all the fraud, right? These huge companies taking all the money that they don't need, and then the smaller guys don't get any. And it's scary to think about, because when you go through an economic situation like this, what happens on the other side of it? Are all the smaller stores and companies closed? So we only have like Amazon and Walmart at the end of it because they got help when they didn't even need it? It's a big problem, and it doesn't end there, because this whole situation, right? All this liquidity, the fact that the stock market is going like this and the economy is going like this, leads to a big problem in our country of wealth disparity or wealth inequality, whatever you want to call it. Because when the stock market is getting inflated, you know who benefits? Anyone who's invested in the stock market. But the truth of the matter is that only half of the country is invested, because the stock market, sadly, is a rich man's game, because they're the only ones with money left over on the side after their bills each month to actually invest. And I know as soon as you call someone rich, they're going to say, no, I'm not rich. No way. Most of my money goes to taxes anyway. And I don't blame anyone for saying that. I feel the same way. But being rich is in comparison to other people. So if you're able to put money in the stock market, you're considered rich, at least for this example. So for example, when stimulus checks went out, right? More liquidity. Well, the richer people, what did they do with that money? Put it into the stock market. The poorer people, what did they do with that money? Used it to buy groceries. And I'm not shaming anyone for investing in the stock market. Of course not. That's my whole livelihood. That's what I do. But we also got to realize what's going on here. So we're getting money, right? Stimulus. We're getting that money, putting into the market. We're seeing the market inflate like crazy. So we're making a bunch of money on that money we invested, where a lot of the country is not benefiting from that, and their businesses are shutting down, they're losing their jobs. So what you get at the end of the day is the rich getting richer and the poor getting poorer. People are already angry about this, and it's getting worse and worse, and it's not going to be pretty at the end of all this. It's that wealth disparity, wealth inequality that is a huge, huge problem. That's the real thing you need to watch when you think about how dislocated the stock market is from the economy. And unfortunately, I don't have a solution for wealth inequality. I'm not smart enough. Only thing I can do is hopefully explain some of this stuff to you so you can continue to build your wealth and hopefully help out the next guy. So speaking of building your wealth and the stock market being the best place to do it, I want you to go ahead and watch this video right here where Warren Buffett explains the one thing you need to be successful in the stock market and grow your wealth. Click that video right here because it's really important to watch, key for your financial future, and I will see you there.